Uh, Good afternoon, everyone. On behalf of Sustainability Reporting Standard Boards, I, CA Dimple Kunal Gogri, extend a warm welcome to all of you to the 29th session of our webinar series, Demystifying Sustainability, Catalyzing Growth. Today's session is centered around a critical theme, climate risk as financial risk, what investors should know. We are honored to have with us CA Preeti Savlaji, the chairperson. Unfortunately, she is not able to join us today. We are also honored to have with us our esteemed speaker, CA Soumyaji. Let us now begin. I would like to invite CA Chintan Rambia to kindly take the session forward. Chintan Rambia, over to you.
Yeah, hi. Good evening, everyone. I would like to welcome everyone for this session on 29th session on climate risk as financial risk and what investors should know. And I would like to introduce our esteemed speaker today, C.A. Soumya Ji. C.A. Soumya Ji is a chartered accountant with over 10 years of experience in financial reporting, auditing, taxation, and statutory compliance. As a partner at SKSG Associates, Chennai, she has led statutory audits and internal audits for banks, corporates, and fintech companies, and also provided expert advisory on tax planning and regulatory matters. Her career spans roles in financial leadership, internal control, implementation, and management reporting. Soumya is also actively involved in the Institute of Chartered Accountants of India as a faculty member, contributor, and technical reviewer, and she frequently delivers guest lectures on auditing, finance, and intellectual property rights. Known for her analytical approach and strong communication skills, she brings both technical expertise and strategic insight to her professional engagement. So, with this brief introduction, I would like to thank Soumya ji for taking this session, and I would like and stage is yours, Soumya ji.
Thank you so much, sir, for this wonderful introduction, wonderful words.
Yeah.
Thank you, everybody over here in the meeting room, SRSB board, the Institute of Chartered Accountants of India, for giving me this golden opportunity. In fact, this is a dream come true to speak under our own alma mater's ICA banner. Though I have delivered lectures at various forums, this is my first CPE seminar lecture. So I'm very happy to go about it. And thank you, listeners who have all viewers joined us for this enriching session. Wish me and bless me. Thank you so much. So I'll share my screen now. Is my screen visible?
Yes, ma'am.
Yeah. Okay. Thank you. Thank you so much. So today's topic is climate risk as financial risk, what investors should know. So over this session, we will see how climate events aren't just environmental headlines, they are balance sheet realities. So before jumping into the topic in deep, I want to get into basics of what is sustainability is. So what is the dictionary meaning of sustainability? Sustainability is derived from the word sustenance, sustain, right? So there is a direct distinct difference between living and sustenance as well. Living is like we are just existing here, absorbing all the five elements, five natural elements outside of us and also inside us. But sustaining or sustenance is next step to living. That is, we are consuming the resources around us and we are adding another dimension to it by doing some jobs, activities via the resources and making it as an economic transaction. So this is where the basics of sustainability is coming. So sustain also have one another meaning like it extends, it have a extended long period of life, right? So from this we are able to derive what sustainability with reference to our environmental factors is. So it is the practice of meeting present needs without compromising the ability of future generations to meet their own needs, achieved by balancing environmental, social, and economic goals. This is a universal definition of sustainability. So, in simple terms, We are responsible for using all the natural resources around us judiciously in the present so that our future generations are not affected. Yes. So, with this background, sustainability and integrated reporting has become the need of the hour. Why? Because all the regulators, international regulators, and people at the helm of the affairs felt the need for integrating sustainability as part of their business ecosystem. So, through IFRS S2, Sustainability Reporting Standards Board, BRSR Core, by SEBI, have mandated sustainability reporting as part of annual financial disclosures that is called as integrated reporting. So we have understood the background of sustainability, why regulators have identified the importance of incorporating sustainability into the financial practices. So many other international bodies are into planning and development of various sustainability related disclosures for us. So in this background, there is a board called Financial Stability Board, FSB. One second. So why this topic matters is it begins here from Financial Stability Board. So Financial Stability Board is based at it is based at Switzerland. It is formed by Bank of International Settlements. Its members are G20 countries, which naturally includes our India and certain European Union countries. So FSB felt that sustainability is not just about reporting our sustainable manufacturing practices, our eco-friendly transition related to sustainability. It is not just about disclosure. It is more than that because there is impending large-scale climate risk that is happening around us, which should be quantified financially so that the businesses don't come to a standstill. So, in this context, what FSB did is they created a task force that is called Task Force on Climate Related Financial Disclosures, TCFD, in 2015. So, what TCFD did, it worked full 3 years in drafting a disclosure requirement. So, in 2017, it came up with a 11 pointer voluntary recommendations relating to climate risk. So, how climate risk has to be perceived as a financial risk in the business, what are the types of climate risk, how and why the investors are affected because of this, and what should we do about it is the entire framework of this disclosure. So, when in 2015 TCFD came up with this disclosure, many countries felt it is very compelling, and they, even though it was given as a voluntary disclosure, many countries adopted it as compulsory disclosure, like Singapore, Canada, Japan, South Africa, United Kingdom, by 2025. So at this point, it would be very interesting to know that in our own country, our Reserve Bank of India has come up with a draft disclosure framework on climate related financial risk for all the regulated entities. So it was issued on 28th February 2024. So the draft disclosure requirement is going to be like presented as a part of financial report from this financial year. So we will discuss about this in detail in the later slides. Yes. So yes. So this session is about TCFD's climate related disclosure financial framework. So what TCFD is speaking about the climate related financial risk, how it has come up with a wonderful thematic blueprint for each and every business to adopt to become financially resilient. Yes. So if we were in a room together, I would ask quick show of hands and ask how many of you think that climate risk is definitely a part of financial risk and it should be part of our financial planning and budgeting. Even if your answer is not yet there, by the end of the session, you will definitely feel that this is a major criteria that should be included in our financial planning. So Each type of business and industry will be affected by a climatic event. Even climatic events are sector specific, industry specific, geographic specific, yes. But if you look at from the losses that it create, from the point of view of losses, more than 53% of the public utilities are damaged due to a catastrophic event, due to a natural calamity, which translates to rupees 7,055 crores annual economic losses in case of a flood, in case of a typhoon, hurricane. Imagine the magnitude of the losses. So if we look at our 50 years or 60, 70 years back, the loss amounts to approximately rupees 4.86 lakhs crores. This is so shocking. So, so I will just give a pass. So what do you think are the major sectors that are highly affected by climate risk? So our first and foremost ranking is, of course, we can guess it is agricultural, forestry, and fishing. So that is widely affected. And then energy and mining, real estate, construction and utilities, heavy industry and manufacturing, automotives, transport, insurance, and banking. It is not that only these industries or these businesses will be affected by because of a climatic event. Each and every industry or business, each and every small business have its own impact. But these are the major industries which have which face huge economic losses because of a climatic event. Yeah. So, what is the agenda for today? So, what are we going to see about? What are we going to speak about? So, here's a roadmap. First, we will decode what climate risk is, then how exactly it translates to a financial risk, and why investors are so worried about it, and how the regulatory and disclosure landscape is influencing this. So, a small practical case study and takeaways and Q&A. Yes. So, these are all TCFD's disclosure on the climate risk. So, what are the types of climate risk? So, physical risk, transition risk, and liability risk. Physical risk is categorized. So, essentially, TCFD's bucket is only physical and transition. I have included liability as a separate type of climate risk because it gives us more holistic understanding about the climate risk. But essentially, TCFD recommendation is only about physical and transition risk. So, physical risk is divided into uh, acute and chronic risk, transition risk, which is studied in the four business perspective: policy, legal, policy and legal, technology, market, and reputation. Liability risk is related to compensation of loss and legal consequences because of violation of environmental laws. So this is the holistic view of how climate risks are categorized. So what is physical risk? What is a physical climate risk? So if we talk in our financial terms, physical risks are like direct cost. They have a very direct impact on the operations of the business. They take the business to a standstill position. They leave the business stranded because of the climatic activities. As we discussed, these risks are geography specific mainly and sector specific and industry specific. So how the organization's performance will be affected because of this, we will see it. So basically, physical risk is divided as acute and chronic risk. So we have listened these terms in medical terminology, right? So the doctor would say you have an acute infection in the lungs and the cancer is chronic. So there lies the difference. Acute is something that is suddenly happening, that is nowhere out of the thing it is happening. That is acute risk. And chronic is the damage is already happening in the environment, either it is natural or man-made. It is happening consistently, and the effects of it is also visibly seen consistently over the years. It is not a single event. Chronic climate risks are not single event. It will continually affect the environment. So this is the basic difference between acute and chronic terminologies. So if we relate these two are climate risk, acute risk, what are the events that will suddenly happen? Climatic events, flood, typhoons, hurricanes. So earthquakes. Earthquakes, it can be both acute and chronic because earthquake is both natural and man-made. Man-made in the sense because of continuous erosion of ground due to heavy construction of dams, injection of poisonous gases in the earth. That is also a reason for earthquakes. But natural movement of tectonic plates is also a cause of earthquake. Earthquake can be both acute and chronic. So in case of chronic, what are the examples? What are the natural examples we have? Global warming, melting glaciers of Himalayas, rising sea levels, tsunami, heat waves that is happening all over our country. Yes. So how this affects the organization? So the financial performance is entirely affected because of changes in water availability, quality of water, food security, extreme temperature changes. All these definitely affect the businesses directly, right? Yes. So we will take some real life examples from the Indian context for physical risk. So a recent floods in very devastating floods in Uttarakhand, Punjab, cloud burst that happened in Kolkata are examples of acute risk. So chronic risk that is consistently happening all over the years. Heat waves in Delhi. If you imagine the air pollution and the heat waves in Delhi, that has not happened overnight, or heat waves in any other part of the country, that has not really happened overnight. It is a consistent damage to the environment, consistent emission of GHG gases in the atmosphere that has caused this severe damage to the environment. And we are experiencing very hot summers around these years. And also erratic monsoons, water scarcity, landslides in hilly areas. As we discussed, this is region specific. So some businesses in hilly areas are more prone to climate risk than businesses in other areas, right? Because there are heavy landslides, snowfalls. We cannot predict what is happening in hilly areas very accurately. So we have come to this important point. So how this is translating as a financial risk, how this physical climate risk is translating as a financial risk. So imagine when a flood is happening, so what is the first thing to be like coming into strand? The communication, the stoppage of communication, stoppage of linkage. It is not about phone and Wi-Fi. The transportation, the logistics, the movement of people or goods or other things from one place to another is severely affected. So the first affected thing is transport difficulties, supply chain interruptions, which lead to reduced revenue from decreased production capacity. There is no movement in anything. So naturally your production stops and there is a reduction in revenue. And the next most important thing in the line of business are people. So when there is a flood, when there is a hurricane, when there is a typhoon, what happens? The people are severely affected. Though we have faced numerous pandemics, natural calamities, and all these decades, we have prepared ourselves to work from anywhere. Human beings are getting prepared to face any kind of risk in their life. But still, there will be definitely a minimum downtime in case of a natural calamity, right? So employee absenteeism is there, employee health is in danger, employee safety is in danger. So there is a reduced revenue and higher cost from negative impacts on workforce. That is the one another financial impact. So first, there is no resources supply, then there is no human interaction. Then even though resources are adequate in flood, water will be everywhere, but you cannot use it. That is the irony. So inadequate water supply for manufacturing plants, for for sub-manufacturing plants for everybody. So it increases the operating cost. And the next big thing is the worst affected thing in a climatic event after people and resources are assets, the infrastructure. Imagine in case of a manufacturing or coal and energy plant, which have huge machineries, when the flood is coming, it is irreparably affected. So what happens? The assets must be write off. It should be early, it should go into early retirement stage, right? So this increases the capital cost of the business. Yes. And we have uh, we have spoken about supply side so far. Now we are coming to the consumption side. Imagine during a natural calamity, what is the consumption that will happen in all over the world? Only food, only water, only medicine. These three things only will be in need and will be consumed by each and every individual and nothing else. So all other businesses who are not in the food, water and health sector will be severely affected because of very low levels of consumption during a natural calamity. So we have spoken that the assets will be severely affected. Of course, it will be covered by an insurance premium. You will get your claim settled. But imagine, so if you are renewing your insurance premium after all these natural calamities are over and you have got back to your business. So when what the insurer will do, because you have become a risk profile for him. So what he will do, all of us in the business will know, he will add a load to your insurance premium. Naturally, your insurance premium cost will get increased and your claim to settlement ratio will also reduce. So that will also happen in case of a physical climate risk. So these are the potential financial impacts. There will be more and more potential financial impacts that, but we are speaking it very concisely in these broad buckets. So yes, transition risk. Transition physical risk is something that is very actual, that manifests physically, that we can feel before our eyes. Transition risk can also be seen and felt, but it is not like a physical manifestation like a physical risk. So before going into in detail what is transition risk, I want to explain or state about few interesting facts about our country. So India is the world's second largest steel producer and second largest manufacturer and consumer of cement, and third largest producer of primary aluminum and fifth largest producer of bauxite globally. And these volumes are only expected to rise with all over the years. So imagine, so these sectors are called hard to abate sectors. What are hard to abate sectors? They rely on heavily on fossil fuels like carbon dioxide. They heavily rely on coal and carbon dioxide for their manufacturing processes. So they have the highest global greenhouse emissions. So what is greenhouse gases? Carbon dioxide, nitrous oxide, methane, and few more gases are called greenhouse gases. What these greenhouse gases do is, like, greenhouse gases are essential for our living and sustenance also, because what they do is they revolve in the atmosphere, they absorb the sun's heat, they balance the heat from the sun and heat from the earth. But imagine if the emission of these gases is beyond the limits, it is going beyond the limits, there is a heavy imbalance happening in the atmosphere. So because of that, global warming is happening. So anything is in excess is always a poison. So that is how this greenhouse emissions are severely affecting our country in terms of global warming, especially from the hard to abate sectors. So we have seen that India is the second largest, third largest in so many things. And one other shocking thing I observed in this study is India is the third largest GHG emitter. So we are the third largest pollutant of the world. It is very shocking, and yes, we are being responsible for all these activities. So in case of GHG emissions, if you see, power sector is the largest emitter of GHG gases. 37% of GHG gases are produced by power sector, because power sector, in especially with reference to Indian context, coal is the main raw material for production of electricity. Coal, as you know, it emits tons and tons of CO2 in the atmosphere. And can you guess what is the second sector that is contributing to the emission of GHG gases? I was literally shocked to study about it. It is agriculture. I thought after power and transmission, the energy will come, the transport sector will come. No, it is agriculture. The livestock generate huge methane, so it also contributes to GHG emission. Agriculture sector is contributing 21% of the GHG gases. And then only comes the manufacturing at 17% and transportation sector at 9%. So the CO2 emissions are naturally going to increase. How it is going to increase? By almost 2.6 times by 2050. So now we understand why India is taking sustainability very seriously, integrated reporting, sustainability activities very seriously. So what are the sustainable methods that are being incorporated in the businesses? So attaining net zero position. What is the net zero in simple terms? So if my business is emitting, for example, 5 tons of CO2 to the atmosphere, so what I should do is, it is like balancing. So I'm sending a negative energy to the atmosphere. Correspondingly, I should send a positive energy also to the atmosphere. Like how we can do it, decarbonize. How we decarbonize? What is a very natural source of decarbonization? It is trees and plants, right? So this is one example. There are various types of decarbonization methods that are available in the businesses. So attaining net zero, reducing GHG emissions. Reducing GHG emissions means you are going to alternative sources of raw materials for generating power, for manufacturing cement, right? Yes, alternative energy resources. So all these kinds of transitions are already on the cards. So with the background of this, aren't the business are facing transition risk? Aren't the business who heavily relying on coal or GHG emitting natural materials as their raw materials are heavily facing the transition risk? Yes, TCFD has categorized transition related climate risk into 4. Transmission risk is highly a policy and legal related risk. That is why I said physical risk is manifesting, transition risk is relating to policy, legal, and governance. So, what are the 4 categories? Policy and legal. So, what happens in policy legal? What are the risks that we are facing in policy legal? So, increased pricing of GHG emissions. Naturally, at some point of time, the prices of coal, the prices of other raw materials will increase. Reporting obligations. The detailed reporting obligations for power sector, energy, and mining sector is very huge and very complicated. Mandates and regulations on products and services. See, whenever we speak about a transition risk, it is not just limited to our country. We should imagine it in an international environment. Many countries have adopted our TCFD disclosure as a compulsory disclosure, and many countries are moving towards sustainability in a very fast manner. Imagine there are already a lot of bans happening in US, China, everywhere. But if sustainability is taken very seriously and they are going to ban certain products which are not sustainable, naturally imports and exports from our country will be definitely affected. So this is one example of transition risk. Technology risk. So when we speak about moving to alternative resources, moving to different kind of production methods, so naturally the industries should invest in new technologies, right? Whether it will be built in-house or it will be purchased from outside, anything, technology costs are very high. So if it is in-house, we are not sure that whether the R&D will materialize into an asset, whether the R&D is going to be an expense or whether any intangible asset is going to be created, there is a risk. So, and then market risk. Market risk, what happens? We can prevalently see this in the market. The consumer awareness towards sustainable farming method, sustainable production method, sustainable products is very much increasing. So the customers at some point will have greater awareness and move to sustainable products. So there will be uncertainty in market. So which will increase the cost of raw materials. Yes. And then comes the reputation risk. So all this has happened. What happens? So when the shifts in consumer preferences happen, or we will say, uh, we would have known about greenwashing, that is overstating the sustainable practices of a business or misrepresenting the greener practices of a business to the public and the investor. We have had many practical products like H&M. Unilever was also part of this greenwashing accusation. So when such kind of negative negative observation or negative feedback comes relating to sustainability about the product, what happens in the stock market? The price of the product crashes like anything. So there is a loss of reputation because of shifts in consumer preferences and awareness, stigmatization of the sector. So it is not it is the mentality or it is the tendency of the consumers that if one major player in a particular industry is doing like that, the entire sector will be stigmatized, right? Easily. So this poses severe stakeholder concern. If we are clear about transition risk. So we will see some real life examples in the Indian context with reference to transition risk. So as we saw, coal is the major provider of 70% of India's electricity. So in a decarbonizing economy, if we want to attain a net zero position, imagine the coal reserves, abundant coal reserves in Chhattisgarh, Odisha, Jharkhand, Neyveli. What the huge invested assets, huge capital assets will what will happen to those assets and what will happen to the employees, resources who are engaged in the coal mines, uh, who are working in the coal mines. So that is one example of transition risk. So shift from internal combustion engines. Sorry. So this is one another major transition that is visibly happening in our Indian sector, move towards electronic vehicles, right? Whether it is two-wheeler, four-wheeler, or all the heavy vehicles, whatever the type of vehicle is, the movement towards electronic vehicle is happening crazily. So the motor vehicle is basically based out of internal combustion engines. There are many small and medium scale enterprises who are supplying raw material spare parts to the motor vehicle companies. So imagine the movement towards or consumption towards increase in consumption towards electronic vehicles will pose serious risk to all the motor vehicle sector businesses. So if you, because this is a movement towards sustainability, our government is also incentivizing the buyer and seller of the EV, because this is a very radical shift and solution for the GHG emission from the transport sector, right? If you see, our premier or market leaders in the motor vehicle business are gradually introducing EV models in their own segments. That is not just about the competition. They have understood or realized the importance of moving towards sustainability and being relevant in the business, right? So, and then change in agriculture methods. This has been a major challenge with the individual consumers because this organic movement is happening. I would say since 20-25 years, movement towards organic farming, usage of less harmful fertilizers. So there is an increasing market pressure for farmers to adopt for new crops and technologies where their financial position and their infrastructure does not support for such alternatives, right? So these are the examples of transition risk. So what are the potential financial impacts of a transition risk? So as we saw in policy and legal, there is increased insurance premium. So your your heavily invested capital assets are under risk. So there is higher compliance cost. So, so naturally your insurance premium will increase. So there is increased operating cost, write-offs, assets impairment, and retirement of existing assets. This will happen heavily due to policy and legal changes. So technology changes, as we discussed, research and development expenditures in new and alternative technologies. So it is capital intensive. It is the new development and new development technologies will entail will consume more of the time and resources of the business than anything. As we discussed, market. So there is abrupt and unexpected shifts in energy costs. So change in revenue mixes because of the consumer preferences. Consumer is moving from one type of product to another type of product. There is change in revenue mix. So naturally, the businesses are forced to reprice their assets, rethink about their manufacturing cost, right? Repricing are just not about the products, repricing of assets is also required, like fossil fuel reserves, land valuations, security valuations. Everything is going under tremendous change because of a transition risk. And of course, reputation. Because of the loss of reputation, there will be heavy market turbulence to the products. So reduced demand for goods and services due to shift in consumer preferences, reduced revenue from negative impacts on workforce management and planning. So we have come to the final category of the climate risk. So liability risk is not essentially propounded by TCFD. So this categorization is for better understanding, because liability risk is part of a transition risk, if you ask me. I felt transition risk is more towards compliance, but liability risk is more towards non-compliance, isn't it? Because where liability risk arises, if your business is not compliant with the local environmental regulations, if your business is not adopting environmentally sustainable practices, and if the business is greenwashing, it is misrepresenting to the investors and the consumers at large, so your business is at greater risk. Greater risk to what? Greater risk to legal suits, greater risk to loss of reputation, greater risk to closure of business. Imagine uh, a textile dyeing industry. They pass on the effluents to the nearby lakes. That is a normal practice I have seen, nearby lakes and ponds, right? So now the groundwater quality of that region is heavily disturbed. So if the government is going to pass on serious regulations regarding this, and the business is not complying with any of this, the government will just issue notice to close the business. That's it. So liability risk is more complicated and more dangerous because physical risk is out of the business hands. Transition risk is very well within the business hands, but there is a breathing time. We can plan for a transition risk, but in case of liability risk, we are very much we are very much not aware of what are the potential dangers that is going to happen to the business. Your business can really come to an end. Yes. So some real life examples in Indian context is, so the businesses that will be heavily affected due to a liability risk is insurance and banking. So imagine the restructuring and refacement of loans by banks due to COVID, due to floods. How many crores of loans have been restructured due to natural calamities? Imagine during floods, how much of motor insurance claim and business insurance claim was made for insurance. So liability risk is a growing concern for insurance and lenders for sure. And there is also tendency for increased NPAs for banking sector. So, and then directors and officers liability. So naturally people at the helm of affairs, people at the governance face personal liability for failing to address adequately about the climate risk. and misrepresenting the actual facts about the business responsibility towards sustainability. And as we discussed, shareholder litigation, it is not essentially shareholder litigation, it can also be a consumer litigation. So for failing to act on climate risk and for misrepresenting. And as we discussed, regulatory enforcement. So these are liability risks. So we can pursue. So what will be the potential financial impacts of a liability risk? Litigation costs are unpredictable. It will be huge, tremendous. Regulatory penalties and fines. It is also an unpredictable cost to the business, and increased insurance cost, reputational damage. These are the potential financial impacts of a liability risk. So we have come to the most important point. We spoke about what climate risk we are facing. So what are the potential financial impact it is creating? Why does it really matter to the investor? It really matters to the investor because it is his money that is being paid around, right? So in what angles the investors are very much worried? Why investors are considering climate risk as one of the important factors for decision making? First is asset valuation. So the assets are under serious trouble as we discussed in the preceding slides. It impacts the present value of future cash flows. So it introduces a lot of new uncertainties. So we have to naturally increase the discount rate applied for all our projections, right? So this definitely diminishes the value of assets. And return on investment. When the asset valuation is in question, return on investment is also under serious risk. So, but return on investment varies significantly across sectors. As climate risk is varying across sectors, return on investment is also there because certain sectors will show some resilience, like technology and healthcare will show resilience. But in every business sector, will be some way or other emitting GHG gases. GHG gases are not just emitted through manufacturing processes. So why there is a shift to electric vehicle? So when the motor vehicles are emitting GHG gases, the power that we use for our business, whether it is a single room office, whether it is a complex, whether it is a whatever building it is, we are using power electricity on a larger scale. So that is also a part of GHG emission. So these are also impacting the sustainability of technology sector. So one small digression is like AI, artificial intelligence is happening like anything in the recent year. You know that artificial intelligence heavily rely on data centers. Data centers heavily rely on insurmountable amount of electricity and also their cooling requirements because of the heat that is being generated in the data centers. The cooling requirement is also very huge. So the water resources are heavily depleted because of data centers. AI is a boon, but in the background, environment is also affected because of AI. And one interesting thing is like saying please and thank you to AI increases the electricity consumption for the working of AI. See, we are also indirectly contributing, emitting GHG gases. So industries like technology and healthcare will show resilience, but major industries like manufacturing, coal and energy, transportation, the impact on ROI will be very severe. They face heightened vulnerability. So cost of capital. So when we speak about cost of capital, we saw that the banking sector is heavily affected. So when you go for a restructuring of loan, naturally your credit score will be affected. So what is the impact of your credit score being affected? Your interest rate will go high. Your EMI period will be short. So all those exposure will increase the weighted average cost of capital. And as we discussed, there is the volatility in the market. The stability and the market value is in question because of high exposure to climate risk. Yes. So Considering all these, the main thing, so return on investment is, of course, relating to profitability also. So long-term profitability is under severe question because of the physical risk, there is disruption in the business, increased operating costs, decreasing revenues, everything is happening. There is alteration in demand, consumption, your profitability is in question. So the investors are really seriously interested as how businesses are going to incorporate all these climate risks as part of their financial decision. So what are the investors are expecting? Global investor expectation. What the investors are really expecting out of it? The first thing is like disclose everything properly, disclosure and transparency. So there are various disclosure requirements from various bodies like Financial Stability Board, International Sustainability Standards Board, SEBI, RBI. So try to incorporate all the disclosure requirements and report everything transparently. See, whenever there is a new regulation or new compliance requirement, many businesses see it as a burden, see it as a showstopper, sorry, see it as a detriment to their normal business operations. No. See, if you see the TCFD's disclosure requirement, it is very holistic. So one single time it says, of course, studying about climate risk is a lifelong experiment, lifelong experience. But if that is attempted at the first hand, how many of the things are set right in the business? We should always work towards the positive side of a compliance. Compliances are of course a tedious process, but if it is followed to the T, it definitely benefits the business and its investors on a larger scale. So the first requirement is please disclose everything. Please have uniform disclosure. The one another purpose of the International Standards Board providing disclosures all over the country is like have uniformity in the disclosure, because one company is overstating, one company is understating, the investor is not able to judge and take any decision, right? So this is one another purpose of introducing disclosure requirements. The investors are expecting to conduct scenario analysis, stress test your business as how resilient it is towards all the climate risk we have studied. Second is portfolio risk management. So with respect to the investors, what they will say, they will wait for a time, and what will be the next step? They will divest. Divest in the sense they will move towards more sustainable products and more eco-friendly manufacturing methods, but the companies promoting more eco-friendly manufacturing methods, new technologies, they will move towards those products and make their investment. So they will safely exclude the products which have high carbon assets and high carbon sectors. So those businesses face a termination risk due to the energy transition. And one another approach is they reasonably expect the integration, right? So what the investor is expecting, okay, if the business is not able to take new technology on its own, there are many startups or many incubators who are coming up with new ideas. I recently saw a product which it's a AI, it's a robot. It eats the wet waste in the home. Like it is a trash can, but it converts the wet waste into fertilizer, natural fertilizer. So this is one example. So such kind of innovations and inventions are happening from small scale, from individuals and from various incubators. So we can, if the business is not able to do on its own, we can merge or we can acquire or the business can invest in those technology and move towards sustainability, right? So this kind of portfolio management the investors are expecting. So capital reallocation and opportunity. So investors are naturally showing interest to companies that provide solutions for climate adaptation. So If in case of infrastructure, if you see, the consumers are relying more on the stability of the building rather than it looks or the conveniences, right? It should withstand all the floods, all the typhoons, hurricanes that is happening in the country. That is the major expectation that is happening in infrastructure. So such kind of climate resilient practices is required, is expected by the investors. So this is the very important and wonderful concept proposed by TCFD, thematic pillars. This is called as thematic pillars, 4 thematic pillars. So we have spoken enough about the climate risk, what are the potential financial threats, how the business, why the businesses should consider it seriously. This is the how part of it, how we are going to mitigate all these risks. So this is a generic blueprint that can be adopted by any business. It can be customized to every sector. The, the thematic pillars are governance, strategy, risk management, metrics, and targets. So with respect to governance, the first and foremost primary responsibility is with the management, the directors of the company. So what they should do is they should build awareness. So you should take concrete steps to enhance the resilience in building a clear understanding of the risk. So first, make a critical foundation and assess the vulnerabilities. The governance should include all the stakeholders in the discussion and assess what the business is really vulnerable to. Is all the climate threats are the threats to the business? Such kind of exercises, the likelihood, magnitude, everything should be studied by the governance, by the people at the governance. Strategy and risk management. So what is the output of all these studies? So we should definitely devise strategies and manage the impending risk of climate risk. So once we are able to reasonably identify the potential impacts that is happening because of climate, so we should incorporate all these in our financial planning, budgeting exercises, whether it is happening annually, monthly, weekly. So climate risk must be very much part of financial planning of the business. So it strategy, risk management. So metrics and targets is the most difficult part in the thematic pillar because it is the quantification part of the thematic pillar. See, with respect to the climate risk, this is the major challenge. So practically, if you see, there will be a weather prediction. For example, if you say there will be heavy rain with thunderstorms, there is a possibility of red alert, yellow alert, that is all are happening. So we are getting ready for the scenario, but sometimes the rain will never happen. So in that case, are we okay to ignore every weather prediction? So there is a turbulence, right? So the climate risk itself is not, we are not able to judge it. And quantification in the sense the amount of loss that we are going to face because of the climate risk, quantifying it is very difficult. But the TCFD suggests that it can be done reasonably. We cannot predict 100% of what is going to happen, but we can prepare ourselves to face at least 75 to 80% of it, right? So metrics and targets, accounting of scope 1, 2, and 3 emissions. We saw what is GHG emissions. So scope 1, 2, 3 is, scope 1 is direct emission. That is, as we saw, coal, energy, electricity, those sectors directly emit cement, those sectors directly emit GHG out of its manufacturing practices. Scope 2 is the other sectors who use the main product like cement, electricity. So they indirectly contribute to the GHG emission. Scope 3 is the next level, other sectors in the value chain. So accounting of Scope 1, 2, and 3 emissions are required in metrics and targets. So we have seen the TCFD framework, how it is being adopted in the Indian context. It is very much important and relevant for our academic and professional interest. So BRSR core is our guidebook for integrated reporting. TCFD requirements are not directly integrated into the mandatory BRSR core, but are very much foundational to its development because both the framework emphasizes climate-related risk strategy and metrics. There is a BRSR TCFD overlap. There are certain common points that are spoken both by TCFD and overlap because sustainability both cannot live without each other, right? So what are the overlaps? Climate-related risks and opportunities. BRSR requires companies to report on environmental risks and opportunities, which is the core aspect of TCFD recommendations. Governance and oversight, which is a thematic pillar proposed by TCFD. Both frameworks emphasize board oversight and management accountability. Metrics and targets. BRSR also requiring companies to seek details on ESG targets and the progress achieved by the companies. What is the progress you have achieved in your climate related targets? That is mandated by BRSR. That is also mandated by TCFD in metrics and targets. Yes. So what the companies can do is they can integrate by performing a materiality assessment. How much of TCFD is required to be integrated into the BRSR so that our integrated reporting is very holistic. So we should work across frameworks, governance and strategy, cross-referencing with sustainability development goals. It is a complicated exercise, but it is a very comprehensive exercise. So it provides you a holistic reporting context. Yes. So it's not just about the reporting context. Because this is a disclosure requirement, we are frequently using the reporting context. Adopting or taking measures for this disclosure will serve as a foundation for your entire business, sustainability foundation for the entire business. Yes. So this is the most favorite part of this presentation for me. So as we discussed, our own RBI, Reserve Bank of India, has come up with the draft disclosure requirement on climate-related financial risk during February 2024. So who are all this is applicable? It is applicable for all the regulated entities under Reserve Bank of India. So first, all scheduled commercial banks, including all scheduled commercial banks, all Tier 4 primary urban cooperative banks, all NBFCs, and all India financial institutions like Exim Bank, NABARD, NHB, SIDBI. Yes. Local area banks, payments bank, and regional rural bank alone are excluded. Every other financial institution, regulated entities must report on climate-related financial risk. When this is applicable, except for UCBs, all other REs are going to report climate-related financial risk from financial year 25-26. So we are very much eager to study the annual reports of the financial institutions next year, of financial year 25-26. So the RBI has given a relaxation. RBI has actually very beautifully adopted the thematic pillars of TCFD like governance, strategy, risk management, metrics and targets into its own net. So for each and every thematic pillar, there is a baseline disclosure and an enhanced disclosure. Baseline disclosure is very, very basic requirement and information that should be produced by the REs. Enhanced disclosure is additional information, additional methods required. So with respect to this disclosure requirement, the first three thematic pillars are mandatory from financial year 25-26. So the fourth pillar, metrics and targets, because the quantification is difficult, it requires more analysis and study, it is postponed to financial year 27-28. But for the urban cooperative banks, the disclosure of climate related financial risk is from financial year 26-27 only. And the metrics and targets, they need to disclose from financial year 28-29. Yes. But all other financial institutions are going to report from this year. So for each pillar, as we discussed, there is a baseline and enhanced disclosure. That is how, when, why, where under each thematic pillar and how much. That is the fourth pillar. So this should be reported on a standalone basis, very important standalone basis, not consolidated basis. So as we saw, climate risk is a major financial risk for whether it is physical or transition risk is a major financial risk for banking business. Restructuring of loans, refacement of loans, NPAs, write-off of NPAs. How many things have happened in the decades for the banking industry? So RBI thought adaptation of TCFD disclosure requirements is far more important to its own children, right? See how beautifully this thing is being done. Banking is I would say banking is a universe in which all the businesses are under it. Naturally, a climate risk study of a banking sector will involve each and every sector under its house, right? So the RBI is becoming a forerunner in creating a climate risk management portfolio, creating a framework of climate risk management. It has like laid the foundation. It is beginning to build the structure so other businesses can easily adopt, because the initial analysis, initial research part will be done by RBI itself. So it is very easy for the business to adopt the study already made and incorporate it with the business, right? Which is very wonderful. So one another interesting thing is like RBI is also developing a database repository for climate risk. It is called RBCRIS, Reserve Bank Climate Risk Information System. So many things are happening and very interesting things are happening. So excited. Okay. So far, many of you would have felt as a woman. We talked about catastrophes, we talked about calamities, risk, threats, losses, everything. So we have to definitely speak about the positive side of this. There will always be a positive side in every situation. So what are the sunny side of what are the opportunities and financial impacts? So when we are moving towards sustainable practices, what are we doing? We are using energy efficient production and distribution process, energy efficient logistics. We are recycling. Recycling is the most happening and interesting business that is being done in our country. It is happening in the small to large scale. The methods are just amazing. It requires a separate session to discuss about it. Move to energy efficient buildings, reduced water usage and consumption. This is resource efficiency. So what are the financial impacts of this? Reduced operating cost, increased production capacity. Naturally, there will be an increase in revenue, increased value of fixed assets. You are very much objective towards investing in sustainable assets, benefits to workforce management and planning. Because we are moving to a sustainable and a healthy environment, the employees and the workforce and the consumers and the investors, everyone become healthy, and it results in a wonderful workplace. Yes. So products and services. So what are the benefits and opportunities that are from gaining from products and services because of moving towards sustainable practices? Development of low emission goods and services, development of climate adaptation and insurance risk solutions. We should be definitely move towards insurance aware products. Development of new products and services through R&D and innovation. And what is majorly happening because of all this is diversification. We are thinking beyond what we did not do, right? We would have never thought we will do these in the context of business, or our product line will include such kind of technology and such kind of products. We are moving largely towards diversification, shifts in consumer preferences. So what happens because of this? Increased revenue through various product mix, So new solutions to adaptation needs better competitive position. There is a very healthy competition. This is called as healthy competition that will happen in the business scenario. Yes. So because of all this, because of resource efficiency, because of products and services, what is going to happen in the market? There will be entirely new market for green products. Yes. Who knows? There will be it will definitely be on the cards, a new stock market trading sustainable products, use of public sector incentives, access to new assets and locations. So what happens when the businesses move towards sustainability? There is a holistic development. There is a balanced economic growth. Each and every citizen surrounding that particular region or particular business is highly benefited, right? So access to new assets and locations needing insurance coverage. Yes, increased revenue through access to new and emerging markets, increased diversification of financial assets. So these are the opportunities and the positive sides of climate risk, with which the companies can capitalize on all these opportunities and boost their balance sheet and P&L. Yes. So this is our part. So what do we, as chartered accountants, what are we going to do? How are we going to capitalize this scenario for us? And what are the role and opportunities for CAs? Yes. So reporting and disclosure, the companies will require heavily the knowledge partners, people to explain, explore, read, analyze, study about climate related risks and opportunities to ensure compliance with frameworks like TCFD, ISSB, BRSR code. So, as we all know, the SEBI has mandated for the first 500 listed companies to get third party assurance on the integrated reporting. So, that is also there. That opportunity is also there. Risk assessment. So, applying all our financial and analytical skills to assess the financial and non financial impacts. It is also very important. We are, as a chartered accountant, we can assess both the financial and non financial impacts in a very judgmental manner. So we are trained to look like that, think like that. So risk assessment, these can be done as an individual exercise to business organizations that require such kind of service. Strategic advisory. So offering insights and analysis to support organization in developing strategies, developing new products, developing new technologies. And as we discussed, is there any merger or acquisition or joint venture with eco-friendly, eco-waste management industries, eco-friendly production technologies? Is there any possibilities? We have to research and provide strategic advisory to our clients. Integration of ESG information. So how to integrate the basic challenge will be here. How the ESG, environmental social governance, will be integrated into our financial reporting. So that kind of service we can provide. Climate risk management. So identifying, assessing and manage climate related risks and their financial implications. Sustainability consulting. So advising business on the development of sustainable strategies, carbon pricing and green finance incentives. Framework development. So as we discussed, so this is largely with respect to disclosure. So we are developing a framework that very much match with the standards and DDRs that are provided internationally. And technology integration, leveraging technologies like data analytics, blockchain, AI to enhance the transparency and reliability of climate related data. Yes. Okay. So yes, above all these, there are very impending practical challenges in assessing climate related risk, in planning and preparing for it, integrating and quantifying it in the profit and loss, balance sheet, and all our budgets. There are very huge practical challenges sorry, that are present. So, what are the challenges? First is data availability and quality. If you think about the climate data, I would say the meteorological data is the most complex system that we can ever see, apart from the space related infrastructure. The meteorological data will be very complex. It requires analysis of various innumerable factors to assess the climate and weather. So even with the data, it is very unpredictable. It can be historically connected, but it is very unpredictable to incorporate in the business financials. Yes, that is one major challenge with respect to climate risk. And long-term horizons. So the effects of climate risk, physical risk is though the manifestation will be immediate, it will look as short term, but the effects of it will be very much persisting over a long term. It requires a long term view instead of just focusing on short term or just focusing on recouping the business, restructuring the business. It is definitely more of a long term planning. So moving towards short term and long term planning is a difficulty, uncertainty, and tail risk. So yeah, so this is called as tail risk. So this is an unpredictable data. This is the probability is very unpredictable. So the risk that it will happen, it will not happen, is very much impending. So policy and regulatory uncertainty. As we saw, there are numerous disclosure requirements that are coming up every year, but there are also major amendments that are happening in the environmental and business factory laws of our country and all over the world. So that poses serious certainty to heavy manufacturing, power, and energy industries. So as we saw, insurance sector is definitely impacted because of natural calamities, catastrophes. There will be high claims from all the buyers. So how the insurance sector should move? So it should move towards alternative risk transfer. It should move towards insurance, providing low cost insurance to sustainable products, sustainable manufacturing businesses, sustainable businesses. And regarding the life, health, and savings, so naturally there will be more demand for health cover after a natural calamity, but the health cover can be objectively judged with technology. Yes. Banking sector. So how the banking sector is affected? The major sector that is affected due to a natural calamities, agriculture, infrastructure, transport. So there is a drop in real estate values. So increase in non-performing assets. The investments are becoming highly volatile, hard to predict market sentiment. All the risk factors that we studied very much implies to the banking sector. So what is the positive side? As our regulator has come up with a draft disclosure, we are moving towards a risk management perspective, stronger regulatory scrutiny, evolving expectation from stakeholders, and funding for new environmentally friendly opportunities. Yes. So there is a case study. This is done by Mr. Janatana Anjuppa, who is a part of a climate investment advisory group. So on assessing climate-related financial risk in India's IT sector, a case study of Infosys Bangalore. So in his case study, he has propounded various methodologies, inputs, criterions, field work, and he has concluded something. This was very surprising to study. The main risk is physical climate hazards. So Bangalore is very much prone to extreme rainfall and urban flooding and heat-induced power outages. So Infosys is very much prone to this physical climate hazards. So out of this case study, out of all the analysis, he has found out that this is assumption, this is not a accurate figure. Assume downtime of 77 hours per year. The downtime for me is very less, just 77 hours over the year. But we should look at the amount, the quantification of loss this 77 hours is translating into. It's over USD 150 million just for a downtime of 77 hours. So this is one of the most compelling findings of the study. So this is for the IT giant. Imagine every other sector or every other business in Bangalore, how much of economic loss they are going to face. In fact, Infosys is an early adopter of integrated reporting. He has also disclosed in his case study that Infosys disclosure, it requires even more quantification of location-specific climate risk. It is still missing in Infosys integrated report. And we talked about physical risk of for Infosys, the transition risk. Naturally, Infosys would come under scope 2 emission because it does not produce any product. So, like manufacturing, it is into IT. So, scenario modeling of transition risk is saying that scope 2 emissions translates to USD 3.2 million per year in transition cost. This is the loss due to transition risk, the cost of having a transition. Yes. Yes. Global and Indian standards for further reading. I kindly recommend all the listeners to have a gist of study about all of these standards. These are very comprehensive and interesting. IFRS S2, RBI's draft disclosure requirement, ISO 14091-21, 9220, GRI standards, coupled model intercomparison project, SEBI regulation for listed companies on disclosure on ESG risk, National Institute of Disaster Management in Indian framework. Please have a reading, so it will be of great interest for everyone. Okay, I think we have come to the fag end of the presentation. So, what are the takeaways from this session? We should accept and understand and oblige, whatever word you put. Climate risk is financial risk. Investors are definitely factoring it in. If investors are definitely considering for their investment decision, we play a very unique, compelling role for the investors, for the business, for the environment, and for all the stakeholders. Yes. I want all of you, all the listeners, to think about, reflect on these questions and think how we can work on it. So, what is the one way you think you can integrate climate risk in your role? How would you like to encourage your management to consider climate risk as one of the important factors in decision making? How would you convince your clients to consider voluntary disclosure relating to climate related financial risk? See, it is not just about voluntary compulsory disclosure. It is a impending requirement for each and every business, every size of business, whether we can convince the business owners and stakeholders to incorporate climate risk as financial risk in the financial planning. So these are the resources and references. I thank my sister Bala Meenakshi for curating this presentation, and I thank each and every one of you for patiently listening to this presentation. And I thank our Institute of Chartered Accountants of India, SRSP board, for giving this wonderful opportunity to present this topic before you. Before 2 days, I attended a presentation or a CP webinar, which was presided by Honorable Madhukar Hiragange. He said one interesting and wonderful point. A true professional is not someone who knows answer for every question. A true professional gets back to every question. So I really liked it. Now the floor is open for Q&A. I'm very open to answer the question, whichever I know. If I am not knowing the relevant answer, you can very much write to my mail ID. I'm happy to help you. Thank you so much.
Thank you, ma'am. Thank you for that insightful and thought-provoking session, ma'am. The discussions has truly highlighted how the climate considerations are no longer just an environmental concern, but a core financial and strategic issue for businesses as well as investors. As chartered accountants, I think our role in understanding, measuring, and communicating this risk is becoming increasingly critical. So, on behalf of the audience, now I would like to ask a few questions that they have posted.
Sure.
So, okay. So, how do acute events like floods and chronic risk, like rising temperatures, affect long-term financial stability and capital allocation?
See, as we discussed, there is a heavy impact on the assets and infrastructure of the business. So that is like, if there is a prediction that a flood is going to happen, so there will be, we will definitely see, I would say the disaster recovery planning will be very much present in each and every type of business, right? But the disaster recovery planning is only towards safety and security of the assets. It does not present the financial aspects of the other side of the disaster recovery, right? It is the major part. That is the only thing which take longer time to recover. So if you ask me, tweaking our disaster recovery plan as a financial planning will give more insights as how our assets will be affected in long term.
Okay. The next question is, how are global investors like BlackRock or Vanguard integrating climate risk into investments and portfolio management?
I do not have a complete fair idea about this, but as far as my knowledge, they are considering to introduce net zero asset managers. So asset managers that who will focus only on products, share securities that focus on net zero targets.
The next question is, what are the key financial metrics or indicators investors look for in climate related disclosures?
Ideally, it would be the first thing is like how the operating cost will be supported. So in case of lack of raw materials, the shortage of supply of raw materials, labor, every direct cost related expenses, how that will be managed. So that is the first thing every investor will be interested to know. So like how we are going to resume the business primarily, and of course how whether the business is adequately insured, the insurance cost is really considered. Yes.
Okay. The next question is, how does recognizing climate risk change the cost of capital or credit worthiness of a company?
See, this is the lending side. This is the lending side, banking and finance sector side of our study. So, because of if the business is not affected by a climatic event, so naturally there will not be any risk factors that will be affecting the business. But every business will be affected by a climatic event. So there will be a restructuring of loan. There will be increase in insurance cost. So insurance set aside, there will be restructuring of loans. At least we will require some extension of like repayment tenure, right? So all these will definitely impact the credit rating of the lender. So once the credit rating is impacted, your further loans, they will provide only at a higher rate of interest.
Okay. Now, to what extent is India's investment ecosystem ready for climate aligned financial disclosures and stress testing?
I really do not have an answer to the question. I myself have to do a lot of research about this. I'm very much interested. I do not have a quantified figure regarding this,
No issue.
I will note it down and definitely.
Yeah, okay, no problem. The next question is, how does recognizing climate risk change what are the challenges do Indian businesses face in meeting these disclosure expectations? The disclosures like SEBI, BRSR code and RBI draft climate disclosure guidelines.
See, largely I would say we have been conditioned to think in only in a certain way. All these years, when it is financials, it is balance sheet, P&L, cash flow statement, budgets, that is it. So now we have come to a point to think beyond the financials, to integrate each and every non-qualitative aspect that is affecting the financials. That is where I think our institute plays a larger role in providing a lot of guidance note, policies, accounting standards in considering how to incorporate such kind of uncertain situations which is not readily quantifiable into the financials.
Now, what role will the Reserve Bank climate risk information system play in bridging climate data gaps?
It is going to be a heavy change as far as I feel, because as I discussed during the presentation, this is a major move by RBI, because the net is very big. RBI's, the financial institutions net is very big. The NBFCs, the growing NBFCs, the growing financial availability to various businesses. So when climate risk study is done by the banking sector, I feel it is for everyone, each and every business sector in our country, in the entire business. So as we saw, RBI is building a database regarding this. So it will be very helpful, largely helpful. It will serve as a one-stop place for assessing and researching about all the climate-related risks and opportunities for the business.
Okay. How can organizations ensure consistency, comparability, and reliability in their climate-related financial reporting?
This is very subjective. Yeah, this is a very subjective, and it depends purely on the governance. So, what is the style of governance the organization having? How the governance, that is the management, is giving seriousness to such kind of factors and disclosures with respect to the financial statement. Single-handedly, the governance would play a major role in this.
Okay. Okay. Now, regarding us chartered accountants, what skills and capacities do chartered accountants need to develop to undertake climate assurance engagements effectively?
Yes. So I think we can. We are masters in learning anything new that is coming up. We are definitely the masters. I think. See, the climate-related study. It a very basic understanding of how a climatic event happens, how it is going to affect it, on what scale it is going to be affected, is enough for undertaking climate-related financial analysis. We do not need an advanced technical knowledge of how everything is happening. If that is the case, we can always take help of domain experts who are there. But a very basic knowledge of climate-related scenarios is sufficient. And the scenario analysis, the in-depth knowledge of scenario analysis and stress testing is very important skill to develop. Lot of simulation methods, lot of use of technology because simulation, I am speaking in a theoretical manner. If I do it in a practical thing, it is very difficult. Simulating each and every scenario and seeing what is the output is and preparing for the output, it is practically difficult. So we should develop our expertise towards using technology, financial analysis, dashboard technologies to conduct simulation analysis. And we can incorporate our financial analysis knowledge into it and work on it, is what I think.
Okay. Now, how can chartered accountants practically integrate climate-related risk into traditional financial reporting and valuation models, especially when data and quantification methods are still evolving?
See, I would suggest as a first step, if it is not a listed company, if it is not mandated, integrating into financial reporting itself is a very complicated and challenging task. At least we can begin with integrating it into financial planning. So it would be more, I would not say easy, it would be more viable, and it would definitely work as a starting point to integrate into financial reporting at least after 2 or 3 years.
Now, something for regulatory, with the increasing global focus on frameworks like ISSB and SEBI's BRSR, how prepared are Indian companies and auditors to meet the expectations of the transparent climate risk reporting?
That is also a very subjective question. I think we are getting prepared.
Slowly and steadily.
Yeah, we are getting prepared day by day.
Okay. Now, the Infosys case highlighted both physical and transition risk. How can companies integrate location-specific climate risk modeling into their enterprise risk management?
Yes, see, as we discussed, so a very basic understanding of what the climate event of an environment is necessary for our initial analysis. But if required, if this is going to be a serious task, serious exercise, and this is going to be a serious integration, so we can definitely seek the help of experts, technological domains who have expertise in predicting the weather conditions, the impact of the weather conditions, the groundwater resources level, all those things. We can seek the help of technological experts and then proceed with.
Okay. Now, how can the finance function contribute to strategic capital allocation for climate resilience? Ma'am, we are not able to hear you. I am not able to hear you. Mm.
No, ma'am has gone. I think she's not audible.
No, ma'am, you're not audible.
Not yet, not yet.
Can you hear me now?
Yes, ma'am.
Yeah. I think I don't have a clear answer for that question as of now. I have to definitely think over it. I'm noting it down also.
Yeah, okay, no problem, ma'am. Now the last question. As auditors, how do we strike a balance between verifying climate-related disclosures and ensuring they are both credible and not overly subjective in nature?
See, this is in a very nascent stage. I think for coming, I mean, it should reach the auditing stage. It will take some more years. But as we discussed, this is a holistic study. So this is not just about reading the financials, the true and true and fair view of the financial statements. So the knowledge of the industry at large would help in understanding the overstatement or understatement of facts in the financials, in a particular company's financials.
Thank you so much, ma'am, for your valuable insights and for addressing our questions so patiently and thoughtfully. Now I would request CA Chintan Rambia to present a vote of thanks.
Thank you, Dimple. Evening, everyone. On behalf of the Sustainability Reporting Standards Board of ICAI, I extend my sincere gratitude to each of you for joining us today for the enlightening webinar on climate risk as financial risk and what investors should know. Your participation has been instrumental in making today's session possible. A heartfelt thanks to our esteemed speaker, CA Soumya ji, for sharing her deep expertise and perspectives on climate risk as financial risk, what investors should know. Her presentation has shed light on thought-provoking ideas that are well connected to climate science, financial risk, and investor expectation. The session highlighted that climate risk is no longer a peripheral concern. It is a core detriment of financial stability, enterprise value, and investor confidence. Ma'am, we deeply appreciate your clarity in explaining the physical, transition, and liability risks and how they translate into tangible financial impacts from asset impairment and insurance costs to capital reallocation and reputational risk. Your real life Indian examples, case study insights, and references to RBI's climate disclosure draft, SEBI's BRSR core, and ISSB standards brought great relevance and context to today's discussion. It is encouraging to see how India is aligning itself with international benchmarks for credible, comparable, and decision-useful sustainability disclosures. Special thanks to our participants whose engagement and thoughtful questions enriched today's discussion, truly turning into this a collaborative learning experience. We also invite all the participants to join us for our upcoming webinar scheduled for next Thursday, which is at 3 p.m. to 5 p.m., where we will continue exploring crucial topics in sustainability reporting and best practices. Your dedication to advancing sustainability practices is invaluable, and we look forward to your continued involvement in our ongoing initiatives as we collectively pave the way towards a more sustainable and resilient future. Thank you so much. Thank you so much.
Thank you. Thank you so much. Thank you.
Very nice session, ma'am. Thank you.
Thank you. Thank you for the wonderful words. Thank you so much. Thank you, Dimple. Thank you, everyone.
Yeah, thank you so much.
Thank you.
I think we'll end the webinar now. Yeah.
Yeah.
Tech support.